Natasha Miss?
Yes, sir.
Natasha Miss?
Yes, sir.
Natasha Miss?
So can you hear me?
Yes, I can hear you.
Yeah.
Okay, Natasha Miss, we can start the session now. Nadika has joined.
Yes. Okay. So good evening, everyone. As we all know, today we have a guest lecture, especially a very important lesson when it comes to our taxation syllabus, that is value-added tax. We call it VAT. So this will be conducted by Mr. Nadika Suranjana, our guest lecturer. Let me introduce our guest lecturer first. So Mr. Nadika Suranjana is a well experienced tax specialist in the field of taxation, and currently he serves as the tax partner at Vijayaratna and Company. He was also a tax partner at Nihal Hettiarachchi and Company as well. So he has a very wide experience when it comes to taxation with his positions. And Mr. Nadik Suranjan is a proud product of our own department, Department of Accounting, and having a BSc Accounting special degree. He is an associate chartered accountant and an double AT finalist as well. And most especially, he's a CA subject prize winner for advanced taxation and strategic tax planning. So, when it comes to value added tax, this is a very important lesson, and then you will be able to get to know more about this aspect, especially the practical aspects, theoretical aspects, through Mr. Nadika Suranjana. And before starting the session, we would like to uh, thank him very well, because not only this year, last year, the year before, so he joined this, and he always continuously supporting the Department of Accounting and the students. So thank you very much, sir, for accepting our invitation and joining this session amidst your busy schedule. So over to you, sir. You can start the session now.
Right, good evening all.
Good evening, sir.
Good evening, sir.
Hope you can see the slides and hear me properly.
Yes.
Right. Yes, thank you very much, Natasha Miss and Dishant sir, for continuously inviting me for this presentation. I'm really happy and glad that I'm invited every time when there's a lecture on VAT to share my knowledge and experience with these undergraduates. So thank you very much for that. We'll quickly get into the presentation. Right. As we all are aware, taxes are imposed by acts that are passed in the parliament. So, and collected by the government. So even the government without the proper act that is passed in the parliament cannot charge taxes from the public. So therefore, we have different acts passed in the parliament to collect taxes from the public. As an example, we have the Inland Revenue Act to charge income tax. We have the SSCL Act to charge SSCL. Like that, for value-added tax, we have the Value-Added Tax Act number 14 of 2002. So as you can see, that was introduced in 2002 by this act. That's the act number 14. So basically what we are going to discuss today is some key provisions that are in the Value-Added Tax Act. Right, this will be my presentation outline today. First, we will discuss the imposition of VAT, and thereafter some key interpretations. Then concept of time of supply, registration requirements, and goods or services supplied in Sri Lanka. Then we will discuss about non-taxable supplies, then VAT on importation of goods, then the calculation part, how to calculate the VAT payable. Finally, some basic compliance requirements that are there in the VAT tag. Right. Now, we are going to first look at the imposition of VAT that is given in section 2 of the law, that is known as the charging section of the law. So basically that covers the scope of VAT. So who are the persons who are covered? What are the activities that are covered? So all that is described under this section. So if we look at section 2, there are 3 parts or 3 situations where VAT is charged. We will take one by one and try to get an understanding of the scope of VAT. VAT shall be charged under A. We have at the time of supply on every taxable supply of goods or services made in a taxable period by a registered person in the course of carrying on or carrying out a taxable activity in Sri Lanka. So as you can see, I have highlighted some words here. So during the next 1.5 hours time, we'll be discussing about the meaning of these words. So until we complete that discussion, you will not have a clear understanding of the scope of VAT, but let's try to get a basic understanding for now. If we look at section 2A again, VAT shall be charged at the time of supply. That is basically the time at which VAT should be charged. As an example, now if you take a particular transaction, there are different activities happening differently. Now, as an example, now in a particular transaction, you may collect advances without selling your products or without even issuing an invoice. In a different, in the next transaction, you may issue the invoice first. You deliver the goods later and you collect cash even after that. So these activities happen differently in different transactions. So at what point we should charge VAT is described under this concept, time of supply. We will discuss about that in detail later. Whether it is the time of collection of money, whether it's the time of issuing the invoice, whether it's the time of delivery, at what point we should charge VAT, we will discuss in detail under time of supply. So VAT shall be charged at the time of supply on every taxable supply of goods or services. Before we move forward, let's look at this classification of supply of goods and services. Now, supply of goods and services, we can divide into 2. Taxable supply of goods and services and non-taxable supply of goods and services. Or we call it exempt supplies. So we have 2 supply of goods and services, taxable supplies and non-taxable or exempt supplies. This taxable supply of goods and services, we have again divided into 2. Supplies chargeable at the standard rate and supplies chargeable at the 0 rate. That is of 2 types, standard rate supplies and 0 rate supplies. So very simple classification of goods and services. Keep that classification in your mind. We will discuss about non-taxable supplies, 0 rate, standard rate. We'll discuss that later. But for now, keep this simple classification because most of the provisions of the VAT law you can understand easily and you can read and understand easily with this classification. Supply of goods and services is of 2 types. Some are taxable, some are not taxable. Taxable part is again divided into 2, standard rate supplies and 0 rate supplies. If we go back to section 2A again, VAT is charged on what? It is charged on every taxable supply of goods or services. That means VAT is not charged on non-taxable or exempt supplies. VAT is charged only on taxable supply of goods and services. It could be a supply that is chargeable at the zero rate. It could be a supply that is chargeable at the standard rate. Made in a taxable period. So VAT is charged with respect to a particular specific period. It could be a 1 month period. It could be a 3 months period. We will discuss the situations where the 1 month period is applicable and the 3 months period is applicable later. Then by a registered person. To charge VAT, the person who does this supply should be a registered person. Because now this is a special authority given to you by the government to collect taxes from the public on behalf of the government. So you are collecting taxes from the public on behalf of the government. That authority is given to you. So the VAT you collect is not your money, it's not your property. The VAT you collect has to be paid back to the government. Right? If you are not a registered person and if you are allowed to charge or collect taxes from the public, what you do and the money you collect, the activities you do can't be monitored. So therefore, first you have to be a registered person to charge VAT, then only your activities can be monitored by the government. In the course of carrying out a taxable activity in Sri Lanka. Another important word, taxable activity. So in the next slide, we will discuss about the meaning of taxable activity. There are 5 activities that the Act has recognized as taxable activities. You have to do one of these activities to be liable for value-added tax. And that particular activity should be carried out in Sri Lanka. So there are conditions to be satisfied to be liable for value-added tax. Now, these conditions, if you look at again, there should be a taxable activity that is carried out in Sri Lanka. And when you are doing that taxable activity, what you have to supply? You have to supply taxable goods or services. You have to make taxable supply of goods or services. Even if there is a taxable activity, if you supply non-taxable goods or services, then that is, then again, you are not within the scope, right? So, and also that alone, and also you must be a registered person, right? Those conditions you have to satisfy to be liable for value-added tax. So that's part A. Once we complete our discussion on these highlighted words, then we will have a better understanding about the scope. Then the second situation, VAT shall be charged on the importation of goods into Sri Lanka by any person. By any person, not a registered person. You don't have to get you don't have to be a registered person to import goods into Sri Lanka. When you bring goods from a foreign country to Sri Lanka, that's an importation. So on the importation also, VAT is charged. That's the second situation. Now, if you look at A and B, under A, VAT is charged on supply of goods or services. Under B, VAT is charged on importation of goods. We have both goods and services under A, but we have only goods under importation. So what is missing in B is importation of services. Importation of services is not there. So what are the implications of not having importation of services under the VAT scope? Now, let's say you want to get a particular service, and there are service providers in Sri Lanka and also outside Sri Lanka. Now, if this particular service is provided by a person who is in Sri Lanka, he is covered under Section 2A because he is supplying a service. So he is chargeable with VAT. When you get the same service from a person outside Sri Lanka, he is not covered under A, and also he is not covered under B also. Because importation of goods is liable, importation of services is not covered within this scope. Right? So the implication would be, if you are the end customer and if you cannot claim input taxes, we'll discuss about that. And the VAT you pay on your purchases would be your cost. It's a part of your cost. Then you are concerned about the cost you incur on your purchases. When you get the service you want from a person in Sri Lanka, because that person is liable to pay VAT under Section 2A, he will charge VAT from you. I think you all know that the VAT rate is 18%. So he will charge 18% VAT on the service he supplies. But when you get the same service from a person outside Sri Lanka, that non-resident person is not liable to pay VAT in Sri Lanka. So there won't be any VAT that is charged by the non-resident person from you. So the price you pay is higher when you get the service from a person in Sri Lanka. So the local service providers, they find it difficult to compete with foreign service providers because of the scope of VAT. So the government took a policy decision recently to bring those non-resident suppliers also into the VAT net by introducing Part C under this scope. VAT shall be charged on the supply of services by a non-resident person through an electronic platform to a person in Sri Lanka with effect from 1st April 2026. So that is not actually effective yet, but that was actually the government wanted to make this provision effective from 1st October last year. Then they postponed it to 1st April 2026. But so far, we don't have any guidelines or instructions from the Department of Inland Revenue or from the Finance Ministry about the implementation of this Part C under the law to bring non-residents into the VAT net. Most probably, this provision may not be implemented with effect from 1st April. But anyway, after that, now there's a provision like this, and even though this is getting delayed, one day this will be implemented. So that is basically the scope of VAT. Now, we will take one by one the meaning of these highlighted words and try to get a better understanding of the scope of VAT. Let's take the first one, section 2A. The following conditions should prevail for chargeability of VAT under this provision. The taxable activity should be carried on or carried out in Sri Lanka. There should be a taxable supply of goods or services, and the person should be a registered person. Now let's look at the meaning of taxable activity. As I told you, the Act has identified 5 activities under this. One has to do one of these activities to be liable for value-added tax. Let's look at the activities that are listed here. Taxable activity means any activity carried on as a business, trade, profession or vocation, other than in the course of employment or every adventure or concern in the nature of a trade. Any activity carried on as a business. You could be a service provider, you could be a manufacturer, you are covered. And trade. You can buy and sell, you can import and sell. Trading is covered. Profession. Profession, if you are professionally qualified person and you practice in your field, that is covered. The profession is covered. Or vocation, that is where special professional qualification is not required and they work with their experience, like carpenters, astrologers, where no professional qualification is required. That is also anyway covered under taxable activity. Other than in the course of employment. So employment has been excluded. Now, even in an employment, the employees provide services to the employer for a consideration. But that has been excluded from the taxable activity. So employment is not covered, but profession is covered. Now, as an example, a doctor, if he practices, if he has a private practice, then he is practicing his profession and that profession is covered. But when he works for a hospital, that is his employment. That is not covered under taxable activity. Or every adventure or concern in the nature of a trade. If there's a trade with a profit motive, even if it's a single transaction, that is also covered as a taxable activity. Second one, the provision of facilities to its members or others for a consideration and the payment of subscription in the case of a club, association, or organization. Now, there are clubs and associations that provide various facilities or that provide various services to their members. To maintain the membership, the members have to pay subscriptions or membership fees to get those services. So those activities these clubs and associations are doing are also covered within this taxable activity. Next one, anything done in connection with the commencement or cessation of any activity or provision of facilities referred to in A or B. Now, if you do anything that is related to, let's say, opening up of a business or closing down of a business, that is also covered as a taxable activity. The hiring or leasing of any movable property or the renting or leasing of immovable property or the administration of any property. Basically, your rental income by renting out, it could be movable or it could be immovable. That activity is also covered. In addition to that, even when you undertake to administer property, that activity is also covered within this definition. The last one, the exploitation of any intangible property such as patents, copyrights, or other similar assets where such asset is registered in Sri Lanka or the owner of such asset is domiciled in Sri Lanka. Now, using an intangible asset, if that asset is registered here, or even if it is not registered in Sri Lanka, if the owner of such intangible asset is residing in Sri Lanka, that is also treated as a taxable activity. As an example, you write a book and you give it to a publisher to publish and sell. When your book is sold, you get royalty income. Now, the owner of that copyright is residing here. So that activity falls within the meaning of taxable activity. But if you take a global brand like Coca-Cola, that is not covered here. Using that foreign brand is not covered here because it's not a brand that is registered here, or the owners are not residing in Sri Lanka. So these are the activities that are treated as taxable activities. As I told you, to be liable for value-added tax, one has to do one of these activities. Let's look at question number 1 to understand the meaning of taxable activity. A company which is engaged in the business of manufacture of articles has the following income disclosed for the quarter ended 31st December 2025. Turnover, under turnover, sale of manufactured goods locally, 102 million, sorry. Export of manufactured goods, 500 million. Under other income, they have recorded repair services, 129 million, scrap sales, 35 million, rent income, 5 million, dividend income, 4 million, interest income on fixed deposits, 2.5 million. Identify whether the said items are chargeable with VAT and state the taxable activities into which the said items fall. Whether these items are falling within the meaning of taxable activity. Sale of manufactured goods locally and export of manufactured goods. That is basically their business. That's a manufacturing company. So whether they sell locally or whether they export, that's basically their business. And in addition to that, even if they have recorded that under other income, repair services, scrap sales, they also fall into their business. They are part and parcel of their business. So, sale of manufactured goods locally, export of manufactured goods, repair services, and scrap sales, they are chargeable with VAT and they fall under item A here, because that is covered under business. They fall under item A here for the definition for taxable activity. Then we have rental income. For income tax purposes, you may treat this under business income or under investment income. That is for income tax purposes. But for rental VAT purposes, we have a separate activity under which this rent income falls. That is item D here, hiring or leasing of any movable property, or the renting or leasing of immovable property. So that is also chargeable with VAT, and it falls under item D for the definition for taxable activity. Dividend income and interest income on fixed deposits, they are not covered under any of these activities. So on dividend income and interest income, you don't have to pay VAT. They are not chargeable with VAT. I think you are clear about the taxable activity. Now let's look at the meaning of taxable supply. If you can remember the classification that we discussed earlier, supply of goods and services, we have two supplies, taxable supplies and non-taxable supplies. Now we are going to discuss meaning of taxable supply. What does that mean? Taxable supply means any supply of goods or services made or deemed to be made in Sri Lanka, which is chargeable with VAT, chargeable with tax under this act, and includes a supply charge at 0%, other than an exempt supply. That is basically this. Taxable supply, it could be a supply that is chargeable with at the standard rate. It could be a supply that is chargeable at 0 rate, but it doesn't include exempt supplies or non-taxable supplies. Now let's look at the definition for supply of goods and supply of services. So we can either supply goods or services. They are also defined in the Act. First, we take the supply of goods. Supply of goods means the passing of exclusive ownership of goods to another as the owner of such goods or under the authority of any written law, and includes the sale of goods by public auction, the transfer of goods under a hire purchase agreement, the sale of goods in satisfaction of a debt, and the transfer of goods from a taxable activity to a non-taxable activity. Now, basically, supply of goods means as the owner of a particular good, if you pass that ownership to a third party, to another person, there is a supply of goods. That's the basic explanation to supply of goods. And it includes the sale of goods by public auction. Now, as an example, you take a loan by mortgaging a property. Now, you don't pay the loan, you default the loan, and the bank, you have mortgaged the property, so the bank has the right to sell your property to recover the loan. Now, the bank is selling your property in a public auction. You are not selling. You are not selling your property, but on behalf of you, the bank is selling that in the public auction. So that says there is a supply of goods. The transfer of goods under hire purchase agreement, when goods are supplied under hire purchase agreement, it is also a supply of goods. Sale of goods in satisfaction of a debt. When you have a debt, without paying that in cash, if you transfer goods in satisfaction of that debt, that says there is a supply of goods. The transfer of goods from a taxable activity to a non-taxable activity. Transfer of goods from a taxable activity to a non-taxable activity. Now, you know the meaning of taxable activity. There are 5 activities. If you are transferring goods from a taxable activity to a non-taxable activity, it's treated as a supply of goods. As an example, now you want to donate some goods that are available for sale in your business to a temple. What you are doing, you are transferring goods from your business, which is the taxable activity, to a non-taxable activity. Another example, if you want to use the goods that are available for sale in your business, you want to take it for your personal use. Then again, you are transferring goods from a taxable activity to a non-taxable activity. So these are the, so that's the basically the meaning of supply of goods. Then we have supply of services. Now this is a tricky definition. Now let's look at the way it has been defined. Supply of services means any supply which is not a supply of goods. Any supply which is not a supply of goods. Now we have 2 supplies. It could be supply of goods or it could be supply of services. Now supply of goods is defined. That is defined. Supply of services is defined to include all the other supplies that are not covered under supply of goods. Now, when you have a definition like this, there can't be any room for misinterpretations. If any supply doesn't fall within supply of goods, it will definitely fall under supply of services, because that is defined to include all the other supplies that are not treated as supply of goods. So supply of services means any supply which is not a supply of goods and includes any loss incurred in a taxable activity for which an indemnity is due. So if there's a loss that you have incurred in your taxable activity when you are carrying on your taxable activity, and if that loss is indemnified, that is also treated as a supply of service. As an example, if your inventories are damaged by flood or fire, then you are incurring a loss because of the damage when you are running your business, which is your taxable activity. Now you incur a loss in a taxable activity. And if you are insured, then the insurance company has to pay your claim. Then your loss is indemnified. Right? So that activity is coming under supply of services. If you incur a loss and the loss is indemnified, then that is treated as a supply of services. Let's look at question number 2 and 3. Advise whether the following supplies fall within the meaning of taxable supplies for the purpose of chargeability of VAT. Supply of manufactured goods which is chargeable at the standard rate of 18%. So again, that classification, supply of taxable supply of goods and services, we have 2 types. Supplies that are chargeable at the standard rate, supplies that are chargeable at the 0 rate. It doesn't include exempt or non-taxable supplies. So supply of manufactured goods, which is chargeable at the standard rate, of course, that's a taxable supply. Export of manufactured goods, which is chargeable at 0%, that is also a taxable supply. Supply of electricity, which is an exempt supply under the first schedule to the Act. So you know that exempt or non-taxable supplies do not fall under taxable supply. So supply of electricity is not a taxable supply and is not chargeable with VAT. Section number 3, advise whether the following transactions fall within the scope of VAT as a supply of goods or a supply of service for a VAT registered company. Sale of manufactured goods. You are the owner of the goods, manufactured good. When you are selling, you are passing the exclusive ownership of the goods to your customer. So that's a supply of goods. Export of manufactured goods, whether it is local sale, whether it's export, you are transferring the ownership. Therefore, export of goods also a supply of goods. Disposal of machinery, again, you are transferring the ownership. That is also a supply of goods. Donation of manufactured goods to the government. As I told you, you are transferring goods from a taxable activity to a non-taxable activity that is treated as a supply of goods. Renting of part of business premises. Do you transfer the ownership of the business premises to the tenant? No. So therefore, it doesn't fall under supply of goods. Therefore, it will definitely fall under supply of services. So it's a supply of service. Insurance claim received in respect of damaged stocks manufactured by the company. As I told you, if there's a loss incurred in a taxable activity and if that loss is indemnified, that is a supply of service. Right. So when we discuss Section 2A, I told you that VAT is charged with respect to a particular specific period. Now we are going to look at the meaning of this taxable period. So we have two taxable periods under the law. As you can see, under A, we have a 1 month period. Then here we have 3 months taxable period. Right. Now let's look at the persons who are covered under 1 month and the persons who are covered under 3 months taxable period. Taxable period means a period of 1 month when a person is registered as an eligible exporter under the Act. If you are an eligible exporter as per the Act, then the applicable taxable period is 1 month. Where any person supplies goods or services to any strategic development project during the project implementation period or any specified project identified by the minister. So there are special projects approved by the minister as well as strategic development projects that are approved by the parliament. So there's a separate act for strategic development projects. So if you are supplying goods or services to these special projects, specified projects by the minister or strategic development projects, you are coming under 1 month taxable period. Next one, when a registered person has commenced a business or started the project and undertakes to comply with the requirements of Section 22(7) of the Value Added Tax Act. Now, this is a special registration that is given under the law, that is given under Section 22(7) of the Act. Generally, there are some projects that take a considerable time to make taxable supplies. As an example, you can take a hotel project. They have to find a land, they have to build their, construct their building, they have to furnish it, interior decorations, gardening, all that they have to do before they make a taxable supply, before they supply foods and accommodation and other services. There's a long process they have to complete, and that process takes a significant period of time. So even without making a supply of goods or services, even without making a supply of goods and services, you are allowed under this special section to get the registration during the project implementation period. So generally 30 months are given to do your preparation work and to prepare with your taxable supplies, right? So if you are a registered person under section 22(7) of the law, the applicable taxable period is 1 month period. Section 22(7), where any registered person has proved that a person has commenced any business or any project in Sri Lanka and undertakes to make taxable supplies in respect of such business or project within a period of 30 months from the commencement of such operation, then he may register such person subject to such conditions as may be specified by him. This is special registration. There are conditions and other requirements to get these registrations. But anyway, if a person is registered under section 22(7), the applicable taxable period is a 1 month taxable period. The other taxable period is 3 months taxable period. If you are not falling under 1 month taxable period, then the 3 months taxable period is applicable to you. That's a simple explanation I can give. The persons who are covered under 1 month period are given. So if you are not falling under 1 month period, then the 3 months taxable period is applicable to you. And even if you are coming under 1 month period, then if you still want to come under 3 months period, that is also allowed. As an eligible exporter, he is generally covered under 1 month period, but he wants to come under 3 months period. So you can come under 3 months period, but that is with the approval of the Commissioner General of Inland Revenue. So a period of 3 months commencing respectively on the first day of January, the first day of April, the first day of July, and the first day of October of each year in respect of a registered person other than A above, those who are not covered under 1 month period, or who opts to submit quarterly returns on the approval of the Commissioner General. Right. One of the most important, I would say, topic, time of supply. If you can remember section 2A, what shall be charged at the time of supply? Time of supply is the time at which VAT is chargeable. Now, this has been explained, the concept of time of supply has been explained in relation to 4 circumstances. Now here under 3.1, you can see time of supply in relation to supply of goods. When you supply goods, at what time you should charge VAT? So that is explained under 3.1. Here 3.2, time of supply in relation to supply of services. When you supply services, at what point you should charge VAT? 3.3 and 3.4 are special situations that we will discuss later. First, we look at the general provisions that are applicable. Time of supply in relation to supply of goods and time of supply in relation to supply of services. Those are the provisions that are generally applicable. Now, understand this carefully. Time of supply in relation to supply of goods. Now the Act has identified 4 activities that can happen when you supply goods. Now those I have given here from A to D. Now let's look at the activities. The issue of an invoice by the supplier in respect of the goods. That's the time of issue in the invoice. A payment for the goods, including any advance payment received by the supplier. That's the time of collection of your money for that supply you made. A payment for the good is due to the supplier in respect of such supply. That's the due date for the payment. Last one, the delivery of the goods have been effected. That's the time of delivery. Now there are 4 activities: time of collection of money, time of issuing the invoice, time of delivery, and the due date. Out of these 4, at what point we should charge VAT? So that is described here. The supply of goods shall be deemed to have taken place at the time of the occurrence of any of the following, whichever occurs earlier. Out of these 4 activities, the activity that happens first decides the time of supply. If you collect cash without issuing an invoice or without delivering goods, what is the activity that has happened first? The collection of cash. At that point, when you collect money, you have to pay back. That's the time of supply. VAT shall be charged at the time of supply. So in this particular example, collection of cash is the time of supply. You pay when you collect cash. Now in a different transaction, you issue the invoice and you deliver the goods later and you collect the cash later. What is the activity that has happened first in that particular transaction? The issue of the invoice. So in that particular transaction, you have to pay back when you issue the invoice. In the first transaction, you have to pay VAT when you collect cash. In the second transaction, you have to pay VAT when you issue the invoice. So you have to identify the activity that has happened first in a particular transaction, and at that point, you have to charge VAT. I think that's clear. However, there is an exception to this. Notwithstanding D above, what is D? Delivery of goods have been effected. Notwithstanding D above, where an invoice is issued in respect of goods delivered within 10 days from the date of delivery of such goods, the time of supply of such goods shall be deemed to be the time at which the invoice was issued. If you deliver the goods today and issue the invoice within 10 days, though you deliver the goods first, you have to take the date of the invoice as the time of supply. That is an exception to the general provision. Next one, time of supply in relation to supply of services. The same story we have here, and the 10 days rule is also there. The supply of services shall be deemed to have taken place at the time of occurrence of any of the following, whichever occurs earlier. We have to identify the activity that has happened first, and that decides the time of supply. The service was performed, the payment is received for the services rendered or for future services. If a payment is due for the services rendered or for future services, or an invoice is issued in respect of the services rendered. Notwithstanding A above, that is the rendering of the service, when invoice is issued in respect of services supplied within 10 days from the date of performance of such service, the time of supply of such service shall be deemed to be the time at which the invoice was issued. If you perform that service and issue the invoice within 10 days, though you perform the service first, you have to take the date of the invoice as the time of supply. Now, as I told you, 3.3 and 3.4 are applicable in special circumstances. Now, let's look at 3.3 first. Time of supply in relation to supply made under an agreement providing for periodical payments. So you make a supply under an agreement and the payments will be made in installments that will be periodical payments. So it has two, these agreements are divided into two: hire purchase agreements or any other agreements other than a hire purchase agreement. Now, if it is a hire purchase agreement, if you supply goods under hire purchase agreement, where goods are supplied under hire purchase agreement, the supply shall be deemed to have taken place at the time the agreement is entered into. At the time the agreement is entered into, when you enter into the agreement, that says that's the time of supply. If it is an agreement other than a hire purchase agreement, the supply shall be deemed to have taken place when the payment is due or when the payment is received, whichever is earlier. Now, if you supply under hire purchase agreement, you have to take the date of the hire purchase agreement as the time of supply. So you are liable to, because VAT is charged at the time of supply. If it is a hire purchase agreement, when you sign the agreement, when you enter into the agreement, that's the time of supply. You have to pay VAT immediately. If it is not a hire purchase agreement, and these agreements provide for periodical payments, the payments will be made in installments in future. If it is not a hire purchase agreement, the time of supply is decided when the payment is received or when the payment is due, whichever is earlier, the earliest date you have to take. This 3.3. 3.4 is a special situation, and also a special authority is required. Now, we discuss about the time of supply in relation to supply of goods and supply of services. Those are the provisions that are generally applicable. Now, under that, can you wait till you collect money from your customers to pay VAT to the government? No, you can't wait. If you issue the invoice and deliver the goods today, and if you give a credit period, let's say 1 month credit period to your customer, you will receive your payment, the selling price plus the VAT that you have added. You will receive that in 1 month period. Can you wait for 1 month to pay that component to the government? No, you can't, because we have to apply the time of supply concept. Since you have issued the invoice today and delivered the goods today, today is the time of supply. So you have to pay VAT today. But you will receive the payment in 1 month's period. So you can't wait till you collect money from your customers to pay VAT to the government. So because of this, there are businesses that are badly impacted when they are unable to manage their cash flows. When we ask them to pay VAT on accrual basis, not on cash basis, it is very difficult for them to manage their cash flows. Now, as a popular example, I can take a construction company. Generally, their margins are low, but the invoice values are very high. They do construction and they issue invoices. But actually, when they issue invoices, they don't know whether they will get this amount even, because The invoice is subject to various alterations. Generally, the customers, engineers, they do various alterations to the invoice, and there will be retentions also. So if we ask this contractor to pay VAT on accrual basis, so he is not he finds it very difficult to manage his business operations. He is unable to manage his cash flows. So there is a provision in that. So if your business is impacted because of the application of time of supply, then you can get a special approval from the Commissioner General of Inland Revenue. That approval is given under Section 23 of the law to apply cash basis to pay VAT. Once you are approved under this cash basis, the time of supply is the time of collection of money, not the time of issuing the invoice, not the time of rendering the service. It's the time of collection of money. So you can wait till you collect money from your customer to pay taxes to the government. But that can be done only with an approval of the Commissioner General of Inland Revenue. Supply on payment basis as directed by the CGIR, where the Commissioner General directs any registered person to account for the tax on a payment basis under Section 23, the time of supply of goods and services supplied by such person shall be the time at which the payment in respect of such supply is received. The time of receipt of money is the time of supply, if you are approved under Section 23. Question number 4. Identify the time of supply in relation to the following circumstances. Goods were delivered on 20th December 2025 and the invoice was issued on 7th January 2026. They have delivered the goods on 20th December and issued the invoice on 7th January 2026, not within 10 days period. So therefore, you have to take the date of delivery as the time of supply, which is 20th December 2025. Second one, goods were delivered on 20th December 2025 and the invoice was issued on 27th December 2025. In that case, the invoice has been issued within 10 days after delivery of goods. So therefore, even though they have delivered the goods, first, you have to take the date of the invoice, which is 27th December 2025 as the time of supply. Invoice was issued on 27th December 2025 and goods were delivered on 30th December 2025. So within 3 days, they have delivered the goods. Can we apply that 10 days rule here? No. Here, they have issued the invoice first. Since they have issued the invoice first, you have to take the date of the invoice anyway as the time of supply. So the third one, for the third one, time of supply is 20th December 2025. Right. Registration. As I told you, you first have to be a registered person to charge VAT because this is a special authority. Once you become a registered person only, you can charge VAT from the public on behalf of the government. So what you do and what you supply and the activities you do, all that can be monitored after you become a registered person. Though the registration is mandatory to charge taxes. Any person registered by CGIR in the following manner shall be a registered person. So who is a registered person is defined. The Commissioner General shall register a person for VAT where an application has been made by any person for registration under Section 10. That is called mandatory registration. The requirements are given under section 10. We will discuss in the next slide. So there are certain registration requirements. If you satisfy those requirements, you must make an application to the Commissioner General of Inland Revenue and you must get the registration. That's called mandatory registration. B, the Commissioner General, having regard to the nature of the activities, is of the opinion that a person is required to be registered but has not made an application to that effect. So you satisfy the conditions that are given under section 10 to be a registered person, but you don't make an application. What will happen? You will be taken by the Commissioner General and you will be registered because you satisfy the registration requirement. So that is called forced registration. You are forcibly registered by the Commissioner General. Whether it is mandatory registration or forced registration, after the registration, you are a registered person. Now let's look at the registration requirements that are given under section 10. So we have two requirements here. The first one is basically based on the amount of or the value of supplies you make. The second one is based on the activities you do. Right. First one, every person who carries on or carries out a taxable activity in Sri Lanka shall register for VAT. Shall register for VAT. If the total value of taxable supplies, now very important, huh? Total value of what? Taxable supplies. You don't take non-taxable supplies or exempt supplies into account. It says only taxable supplies. The total value of taxable supplies in a taxable period, 1 month or 3 months period, has exceeded 15 million at the end of the taxable period. Or the total value of taxable supplies has exceeded 60 million in any 12 months period. So after the taxable period, you take your historical financial data and see whether the value of taxable supply of goods and services that you have made during that taxable period has exceeded 15 million. If you have exceeded, you must make an application and get the registration. Or you take any 12 months period and see whether you have exceeded 60 million, the value of your supplies. If you have exceeded, yes, you should go and get the registration. So the first part, or A here, that is basically based on your historical information. After the taxable period, after 12 months period, you look at your historical data and decide. But B, that is based on your estimated or future data. B, at any time, there are reasonable grounds to believe that the total value of taxable supply is likely to exceed 15 million in any taxable period or 60 million in any 12 months period. Now, let's say you just start a company. You just start a company. And as the first order, you get an order to supply, let's say 100 million worth of goods during the next 1 year period. So you will be supplying 100 million worth of goods during the next 12 months period. So you have now reasonable grounds to believe that the value of taxable supplies will exceed 60 million in the next 12 months period. So then you must make an application and get the registration. Number two, as I told you, this is based on the first one is based on the value of the taxable supplies you make. The second one is based on the activities you do. Every person who imports or exports goods for commercial purposes, very important, commercial purposes, shall be required to be registered. Any person who imports or exports goods for commercial purposes, whether you are below these 15 million or 60 million thresholds or not, if you are importing goods or if you are exporting goods for commercial purposes, even if you are below these 15 million and 60 million thresholds, you must get the registration. So that is why I told the first one is based on the value of supplies you make. The second one is based on the activities you do, where the value of supply is irrelevant. Right. I think that's clear. Those are the requirements you need to satisfy to be a registered person under the VAT law. Right. Then we look at another type of registration called voluntary registration. Now, if you satisfy those conditions that we discussed under section 10, then that is mandatory registration. You are liable to register. But let's say you are below the threshold, but still you want to register and pay VAT. That is also covered, or that is also accommodated. You are not liable to register, but you are entitled to register under the VAT law. You can make an application to the Commissioner General, and with this approval, you can get the registration. That's called voluntary registration. A person who does not satisfy the above conditions cannot register for VAT. However, Commissioner General of Inland Revenue may consider voluntary registration subject to conditions. Question number 5. Determine whether the following persons are required to be registered under the VAT Act. An individual who provides consultancy services with an annual income of 55 million. His annual income is 55 million. The annual threshold is 60 million at the moment. So he is below the threshold, so he is not liable to register. He is not liable to register because his income is less than the given threshold. Not because he is an individual, because he provides consultancy services. It could be his business or it could be his vocation, right? So he is doing a taxable activity. He is supplying a taxable service, but the value of his service is below the threshold. So he is not liable to register. A company which is engaged in the sale of locally purchased goods with an annual turnover of 75 million. So the company has exceeded the annual threshold of 60 million. So the company is required to be registered. A company which is engaged in sale of manufactured goods with a turnover of 18 million for the quarter ended 31st March 2026. However, its estimated revenue from confirmed orders would not exceed 60 million by 31st December 2026. The company has exceeded 15 million threshold during the first quarter because the actual revenue is 18 million. So they have exceeded the 15 million threshold. But as of now, with the confirmed orders, they would not exceed the annual threshold by the end of this year. So their annual estimated revenue will be less than 60 million. Is this company liable to register? Yes, because they exceeded the quarterly threshold of 15 million. You don't have to satisfy both conditions to be liable. If you satisfy one of those conditions, you have to get the registration. Right. Goods or services supplied in Sri Lanka. This also looks simple, but very important in deciding deciding whether tax is applicable or not in certain transactions. Goods or services shall be deemed to be supplied in Sri Lanka. They are treated as supplied in Sri Lanka where the supplier carries on or carries out a taxable activity in Sri Lanka. If the taxable activity is in Sri Lanka, so goods and services are deemed to be supplied in Sri Lanka. And the goods are in Sri Lanka at the time of supply. The goods should be in Sri Lanka when they are supplied, or the services are performed in Sri Lanka by the supplier or his agent. The taxable activity should be carried on or carried out in Sri Lanka, and the goods should be in Sri Lanka when they are supplied, and the services should be performed in Sri Lanka. Let's look at question number 6. Advise whether a company engaged in the business of providing management consultancy services is chargeable with VAT on the following transactions. Services rendered in Sri Lanka to clients in Sri Lanka. So they have rendered the service in Sri Lanka. So that is chargeable with VAT. Services rendered in Sri Lanka to clients outside Sri Lanka, you don't have to worry about the persons to whom you are rendering the service. The place where the service rendered matters. So in this case, services rendered in Sri Lanka. So services have been rendered here, provided here. So you don't have to worry about the recipient of the service. So that is chargeable with VAT. Services rendered outside Sri Lanka to clients outside Sri Lanka. So if the services are rendered outside Sri Lanka, that is not chargeable with VAT because that is outside the scope of VAT. Right. Now we are going to look at the supplies which are not taxable or exempt supplies. Now again, remind the classification that we discussed. Supply of goods and services, we divided into two. Taxable supply of goods and services and non-taxable supply of goods and services or exempt supplies. Now we are going to look at the meaning of these exempt supplies and the goods and services that are treated as non-taxable or exempt supplies. A registered person is chargeable with VAT only in relation to the taxable supplies that we already know. Exempt supplies, Section 8, listed in the first schedule to the Act, are not subject to VAT. Exempt items or non-taxable items are not subject to VAT, right? Now, actually, there is a long list of exempt goods and services. I have given all the exempt items in the presentation, but we don't have time to go through one by one. But I will explain how you should read them and understand. Now, under this exempt schedule, they have been divided into 4 categories. These exempt goods and services have been divided into 4 categories. You can see in this slide the categories: supply or import category, then supply only, then import only, then import and supply category. If a particular good or service is listed under supply or import category, that item is exempt when that item is imported as well as when that item is supplied or sold. If a particular item is listed under supply or import category, understand that it is exempt when it is imported as well as when it is sold. If a particular good or service is identified under supply only category, that is exempt when it is sold. The exemption is applicable when it is supplied only. If that particular item is imported, the VAT is applicable, because since that item is listed under supply only category. If a particular good or services are actually not covered under import category, if a particular good is listed under import only, it is exempt only when it is imported. But when the same item is supplied locally, it is liable to VAT. The last category, import and supply. If a particular item is listed under import and supply category, it is exempt when it is imported and supplied. When it is imported and supplied. So when you look at the exemptions, the exempt items, exempt goods and services, first look at the category under which they are listed. Accordingly, you have to identify whether this particular item is exempt when it is imported or when it is sold. Right? That is how you should read and understand the exemptions or non-taxable supplies. No tax shall be charged on the supply of goods or services and the importation of goods in the first schedule to the Act. Accordingly, supplies and imports are not taxable under zero rated under Section 12. We'll discuss about zero rated supplies later. The exemptions are provided in the first schedule under the following categories. Category A, supply or import. Goods identified under this category are exempt when such goods are supplied or imported. Second category, supply. Goods or services identified under this category are exempt only when they are supplied. Goods, third category, import. Goods identified under this category are exempt only on importation. Import and supply. Goods identified under this category are exempt only when imported goods are supplied. So from the next slide onwards, we have these exempt goods and services. The first one is import or supply of category. There's a long list: wheat and wheat flour, infant milk powder, pharmaceutical products, drugs, Ayurvedic preparation, food, petroleum oil, biofertilizer. There's a long list that you can go through leisurely. Under supply of category, we have educational services, public passenger transport services, electricity. There's a long list under that also. Then we have the third category, import of. There are some goods that are listed under import of category. And the fourth category, import and supply of category. So when you find a free time, go through the list, and they are the goods and services that are exempt from VAT. So VAT is not charged on exempt or non-taxable supplies. Right. If you remember Section 2A, now only we have completed completed discussing about the keywords that were there in section 2A. Right. Now we are going to talk about the VAT on importation. The VAT shall be charged, section 2B, on importation of goods by any person into Sri Lanka. VAT on importation of goods. VAT on importation of goods shall be charged, levied, and collected as if it is a custom duty. So VAT is collected and charged like a custom duty by the Director General of Customs, not the Commissioner General of Inland Revenue. So the VAT is charged on importation and collected by the Director General of Customs on behalf of the Commissioner General of Inland Revenue. Then registration. Right. Before we discuss this, now under section 10, we discussed that if you import goods or export goods for commercial purposes, you must get the registration under the mandatory registration category. You must get the permanent VAT registration. So if you are importing goods for commercial purposes, then you are covered under section 10. Then you have to be a permanent, you have to get the permanent VAT registration. But if you import a particular good that you are not intending to use for commercial purposes, then you have to inform the Commissioner General that your imported goods, and now you need to clear those goods, and you need a temporary identification number to clear the goods. That is called temporary registration. That is given to clear the goods that you have imported. So don't mix this with section 10, because that is applicable when you import goods for commercial purposes. This is applicable when you import goods for non-commercial purposes. So every person who is an importer of goods into Sri Lanka shall notify the Commissioner General not later than 14 days prior to the clearing of such goods that he has imported such goods and obtained from the Commissioner General an identification number for the clearing of such goods. The said notification is not required in the following circumstances: importation under the personal baggage, and person who is already registered for VAT under section 10. If you are already registered under section 10, when you import, you can use the same registration number to clear the goods. Right. Now we are going to look at the calculation part. How we are going to compute the VAT that a registered person has to pay on its supplies. The amount of VAT payable is computed as follows. First, we have to compute the output VAT. Output VAT is computed by applying the tax rate on the value of supply. First, you have to determine the value of supply, and then you have to apply the tax rate. Then you can calculate output tax. From the output tax, you can deduct input tax. From the output tax, you can deduct input tax. And the difference between these two is the VAT that you need to pay to the government. If you look at this carefully, you take your output, you deduct your input. What is left is the value that you have added. So you pay tax on the value you have added. That is why it is called value added tax. Right. How to compute output VAT? Output VAT is computed by applying relevant VAT rates on the value of supply of goods or services. Now we have to identify or understand the value. What is the value of a particular supply and what are the tax rates that are applicable? Now let's first look at the value of supply. So for you, I have taken only the basic rule. So, and that's the rule that is generally applicable. But there are some special transactions where the act has specified different calculation formulas uh, for value of supply. But I will discuss with you only the basic rule that is generally applicable. If the supply is for a consideration in money, you make a supply and you receive money. The value of supply is a consideration minus VAT or open market value, whichever is higher. Value of supply is the consideration minus VAT. Now you have to deduct the VAT you collect from your customer from the total consideration you get. So after you deduct VAT from the total consideration, what is left is the market value. But you have to compare whether that market value, whether that's really the market value. The act says you compare the consideration received minus VAT with the market value and take the higher value. So generally, the both answers should be the same. But there can be situations where the consideration minus VAT is less than the market value. Now, as an example, now you may sell your products, let's say, to a relative at a price which is less than the market value. Now, let's say the mark price is 1,000 rupees. Now you sell this product to a relative for 500 rupees. On that 500, you charge VAT. You get the consideration and you deduct VAT component. And that amount is 500. You compare that with the market value, which is 1,000. Then what will happen? You have to take the higher value, which is the market value, which is 1,000. And that's the value of supply. And apply the VAT rate on that. Right? So we have to be careful when you sell products or services at a price that is lesser than the market value, because we have to take the market value for VAT computation purposes. If the supply is not for a consideration in money or partly in money, again, you have to take the market value. So that is how the value of supply should be determined with regard to supply of goods and services. Right. What we are going to do now, we are going to compute the output VAT. Output VAT is computed by applying the relevant rates on the value of supply. So this is how the value of supply is determined. So now we are going to discuss about the tax rates that are applicable. The following rates are applicable on the value of taxable supply of goods or services. Now basically we have two tax rates, zero rate and the standard rate. That's why we classified taxable supply of goods and services into two, standard rate supplies and zero rate supplies. Zero rate, 0%. Standard rate, currently the applicable standard rate is 18%. We have lesser rate earlier, 15%. Before that, 12%. Even before that, we had 8%. So the time the standard rate has been changed. So currently, the applicable rate is 18%. Right. Now let's look at the zero rated supplies. Now you know the non-taxable or exempt supplies. So that we discussed. Then we have taxable supplies. Under taxable supplies, we have two parts: supplies that are chargeable at the standard rate, supplies that are chargeable at zero rate. Now we are going to discuss about the zero rated supplies. All the other supplies that are all the other taxable supplies that are not covered under zero rated supplies are standard rate supplies. So on all the other supplies, we have to apply 18% VAT rate. Right. Under zero rated supplies, we have three supplies. Here we have A, B, and C. A is basically about goods. Under B, we have some specific services. And under C, we have some general services with some conditions. So let's go by one. Goods shall be zero rated where the supplier has exported such goods for which payment is received in foreign currency through a bank in Sri Lanka within a period of 6 months from the end of the taxable period of which such exportation has taken place. Now, goods are zero rated when they are exported. But there is a condition to satisfy. You need to bring the export proceeds into the country through the banking system within 6 months. This foreign currency remittance requirement was not there. That was introduced recently during the time where we were going through a hard time, the financial crisis period, because our rupee was depreciating. So people or the persons who were exporting, they started parking their export proceeds outside because getting money, because if you park your export proceeds outside Sri Lanka, then you can get the advantage of the exchange rate. So people used to park their export proceeds outside. Then government brought in this clause or condition. If you want to apply 0%, bring the export proceeds through the banking system, not through other unofficial ways. Bring it through the banking system and apply 0%. If you don't bring export proceeds into Sri Lanka within 6 months, what will happen? Then you don't satisfy this condition, then you can't apply 0%. Then what will happen? It's a taxable supply, but it doesn't fall under 0%. Then the standard rate is applicable. And this standard rate is applicable. So if you want to enjoy 0%, bring the proceeds in within 6 months. So that is export of goods. Under B, we have some specific services. Services shall be zero rated where the supply of such services are directly connected with any movable or immovable property outside Sri Lanka for payment in foreign currency within 6 months. The repair of any foreign ship, aircraft, or any merchant ship registered in Sri Lanka, or the refurbishment of marine cargo containers. Any goods imported into Sri Lanka for the purpose of re-export and import trade for payment in foreign currency within 6 months. Copyright, patent, license, trademark, or similar intellectual property right to the extent that such right is for use outside Sri Lanka for payment in foreign currency within 6 months. International transportation, computer software development, client support services, the provision of services to overseas buyers by a government buying office register. Sorry, I have under item A here, this the SWAT should be removed because that is not in operation now. The provision of services to overseas buyers by government buying office for payment in foreign currency within 6 months. So these are some specific services, but the requirement to bring the foreign currencies within 6 months is there. So if you bring the foreign currencies only, you can apply 0% on these specific services. The last one, any other service other than B above. Under B, we have some specific services. So any other service provided by any person in Sri Lanka to another person outside Sri Lanka to be consumed or utilized outside Sri Lanka shall be zero rated, provided that payment for such service in full has been received in foreign currency from outside Sri Lanka through a bank in Sri Lanka within 6 months. So there are 2-3 conditions you need to satisfy here. You have to provide the service to a person outside Sri Lanka, and he has to utilize that service outside Sri Lanka. And for the consideration should be remitted in full through the banking system within 6 months after you perform the service. If you satisfy these conditions, then the applicable rate is 0%. In the case of zero rated supply, no tax shall be charged in respect of such supply. How do you compute your output VAT? You take the value of supply and apply the relevant rate. So when you export goods, you take the value of your supply and you apply 0%. Basically, you are not charging tax on your supply. Also, you are not charging VAT on exempt supplies as well. Then what is the difference between exempt supplies and zero rated supplies? As far as the output VAT is concerned, there is no difference. I'll come to that when we discuss input taxes in a while. In the case of a zero rated supply, no tax shall be charged in respect of such supply, but the supply shall in all other respect be treated as a taxable supply. You don't charge VAT, but still that should be treated as a taxable supply of goods or services. Question number 7, determine the applicable tax rate in respect of the following. Export of goods, you can assume that the export proceeds are remitted through the banking system within 6 months. So export of goods, the applicable VAT rate is 0. Sale of goods to an exporter, is it covered under zero rated supplies? You are not exporting, but you are supplying goods to an exporter. This is not direct export, this is indirect export. So indirect export is not covered under zero rated supplies. So the applicable rate is 18%. Consultancy services provided outside Sri Lanka for payment in Sri Lanka. Consultancy services provided outside Sri Lanka. If you can remember, this doesn't fall within the scope of VAT. The service should be performed in Sri Lanka to be liable. It is not zero rated, it is not exempt, it is outside the scope of VAT. Consultancy services provided in Sri Lanka to a client outside Sri Lanka for payment in foreign currency, and the service is consumed outside Sri Lanka. All the conditions that we discuss under C, under zero rated supplies, are satisfied here. The service has been performed in Sri Lanka it has been given to a person outside Sri Lanka, and he has utilized that service outside Sri Lanka, and they have received the payment in foreign currency. So the conditions are met. Therefore, we can apply 0% on that supply. Consultancy services provided in Sri Lanka to a client outside Sri Lanka for payment in foreign currency, and the service is consumed in Sri Lanka. In this case, the service has been consumed here. To be zero rated, it should have been consumed outside Sri Lanka. Therefore, the applicable rate is 18% in this case. Last one, consultancy services provided in Sri Lanka to a client outside Sri Lanka for payment in Sri Lankan rupees, and the service is consumed in Sri Lanka. They have received the payment in rupees, not foreign currencies, and the service is also consumed in Sri Lanka. Two of the conditions are not met. Therefore, the applicable rate is 18%. Right. Now we are going to discuss about a special adjustment that we need to make when we compute the VAT payable to the government. Now, we discussed about the concept of time of supply. I told you that you can't wait till you collect money from your customers to pay VAT to the government. So, if you deliver goods today and issue the invoice today, and you give a 1 month credit period to your customer, you have to pay VAT today. You can't wait till you collect money after 1 month from your customer to pay VAT to the government when you apply the concept of time of supply. But let's say after 1 month, when you go to collect your money, the customer is bankrupt. Now he says, I am not in a position to pay. Now the VAT component you have already paid to the government by applying the concept of time of supply. Now you are not going to get not only the VAT that you have already paid, also the price that you have sold the goods for. Now I'm talking about a bad debt that you have incurred. Now, if we ask a registered person to pay VAT on your bad debt as well, that is not fair. So there should be an adjustment for bad debts. So this is how the bad debts are adjusted in computing VAT payable. In ascertaining the amount of tax payable, an amount of tax on bad debts incurred in a taxable activity and which has become bad during such period shall be deducted. So the bad debts that you have incurred can be deducted. But if any amount is subsequently received, the amount received shall be treated as a taxable supply during the taxable period in which it was received and shall be liable to tax. Now, when you write your debt as bad, you can deduct it when you compute your taxes. But later, if you recover the bad debt that you have already written off, the recovery shall be treated as a taxable supply in the taxable period in which it is received. Question number 8. Based on the following information, compute the output VAT for the taxable period ended 31st December 2025. Sale of goods locally 52.8 million. Export of goods 15.3 million. Bad debts local sales 1.5 million. Export sales 1 million. Recovery of bad debts of local sales 1.8 million. So how are you going to make these bad debts adjustments in computing your output VAT? Sale of goods locally 52.8 million. So from that, you can deduct the bad debts that you have incurred on local sales, 1.5 million. But you have to add the recovery of bad debts of local sales, 1.8 million. The recovery should be added. So 52.8 million minus 1.5 million plus 1.8 million. The value of supply is 53.1 million. So that is your local sales. So you compute the value of supply, which is 53.1 million. On that, you apply the standard rate. That is 18%. So your output VAT is 9,558,000. That's the output VAT on your local sales. Then we have export of goods, 15.3 million. Bad debts you can deduct 1 million. Then the value of supply will be 14.3 million. On 14.3 million, you apply 0%. The output VAT is 0. So that is how bad debts adjustments are made. Right. Now we are discussing about the calculation part. First, we have to calculate the output VAT. Then we have to calculate, we have to deduct input tax from your output VAT. So we discussed about output VAT and the adjustments that we have to do when we compute output VAT. Now we are going to discuss about input VAT. Now, as a registered person, you can have two types of input taxes. When you purchase goods and services from another person who is also a registered person under the VAT law, he will charge VAT on the supplies he makes. So when you purchase goods or services locally from registered person, there's an input VAT that you pay on your purchases. In addition to that, if you import goods into Sri Lanka, on importation also, you have to pay VAT. So input VAT, we have two types of input taxes. Input VAT you pay on your local purchases and input VAT you pay on your importation. Input VAT in relation to a registered person means the tax charged by another person the tax charged by another person, another registered person on any goods or services to be used by such registered person in carrying out a taxable activity. That's basically the VAT you pay on your local purchases. The tax paid by him on the importation or purchase of goods which are used by such person for the purpose of making taxable supplies. That's basically the VAT you pay on your importation. Then these input taxes you can deduct from your output taxes. A registered person is entitled at the end of each such period to credit for so much of his input tax as is allowable, and then to deduct such amount from any output tax that is due from him. So he is allowed to deduct these taxes from his output taxes. However, any person adopting a payment basis of accounting is entitled to claim credit on so much of his input tax as is allowable only in respect of a supply for which the payment of the tax has been made by such person. What does that mean? Under time of supply concept, we discuss the the cash basis approval. So the time of supply, if you are approved under section 23, the time of supply is the time of collection of money. So you have to pay VAT after you collect your cash, collect your money. So if your output VAT is computed on cash basis, then you are not allowed to deduct your input taxes on accrual basis. You are allowed to deduct your input tax only after you make those payments in cash. If your output VAT is computed on cash basis, your input VAT should also be computed on cash basis. In all the other cases, you can deduct your input taxes, whether you pay it or not. Right. Now, when we are going to deduct our input taxes, there are some restrictions in the VAT tax. So, subject to these restrictions only, we can deduct our input taxes. Now, we are going to look at the restrictions that are there in the VAT law that when we are going to deduct our input taxes. Any input tax attributable to the supply of goods and services received shall not be deducted. Shall not be deducted in respect of the following. Input tax in respect of motor vehicles. Input tax in respect of motor vehicles cannot be deducted. But there are some motor vehicles or situations that the Act has identified. In those situations, you are allowed to deduct input taxes, but in all the other cases, if the input VAT relates to a motor vehicle, it is not deductible. Input tax in respect of motor vehicles other than motorcycles, if your input VAT relates to motorcycles, then you can deduct. If it relates to bicycles, then you can deduct. If it relates to a motor coach provided by an employer for the transportation of his employees, then you can deduct. Motor vehicles used for excursion tours or for the transportation of tourists or transportation of goods or hiring cars, then you can deduct. Motor vehicle forming part of any stock in trade of any taxable activity, then you can deduct. So these are the situations where you can deduct input tax in respect of motor vehicles, but in all the other cases, you can't deduct input tax in respect of motor vehicles. Second restriction, input tax not connected with the taxable activity. Now, again, that classification, the supply of goods and services, we divided into two: taxable supply of goods and services, non-taxable supply of goods and services. If your input tax relates to non-taxable supply of goods or services or exempt supplies, that input tax is not deductible. That input tax is not deductible. But if it relates to taxable supply of goods and services, there is no restriction. You can deduct. So what is restricted here is your input tax attributable to non-taxable or exempt supplies. Right. So that is where the difference is. If you compare zero-rated supplies and exempt supplies, As far as output VAT is concerned, there is no difference. But when it comes to claim of input, there is a difference. Because you can claim input tax with regard to zero rated supplies because it is coming under taxable supplies. You cannot claim input taxes if it relates to non-taxable supplies. That is the difference between zero rated supplies and non-taxable or exempt supplies. If the supply of goods or services received is not connected with the taxable activity or not included in the value of taxable supply, you cannot deduct input taxes. Third one, input tax not supported by a tax invoice or customs goods declaration. As I told you, we have two types of input taxes. Input tax you pay on your purchases and input tax you pay on importation. So if it is an input tax on local purchases, you should have a document called tax invoice, a tax invoice. We'll discuss the meaning of tax invoice and the composition later. You should have a document called tax invoice to support your input taxes if it is a local purchase. And if it is an import, you should have a document called the customs goods declaration, CUSDEC, to support your input taxes on imports. If you don't have a tax invoice or a CUSDEC to support your input taxes, you are not allowed to deduct these taxes from your output taxes. If the supply of goods or services received is not supported by a valid tax invoice or customs goods declaration or other authenticated document issued by the Director General of Customs under the VAT Act. The fourth restriction, input tax not claimed within the prescribed period. There is a prescribed period also within which you need to claim your input taxes. If your input tax relates to a tax invoice, you have 12 months period to deduct it from your output taxes. If your input tax relates to a CUSDEC, you have 24 months from the date of the CUSDEC to claim your input taxes, to make the deduction from your output taxes. If you don't deduct or don't claim these input taxes within the prescribed period, after that period, you are not allowed to deduct those input taxes from your output taxes. So no input tax can be claimed if, in the case of a tax invoice not deducted from the output tax for any taxable period ending on or before the expiry of 12 months from the date of such tax invoice. In the case of a customs goods declaration not deducted from the output tax for any taxable period ending on or before the expiry of 24 months from the date of such custom declaration. The last restriction that is related to zero rated supplies. If the payment in respect of supply of goods or services referred to in subsection 1 of section 7, zero rated supplies, is not received in foreign currency through a bank in Sri Lanka within a period of 6 months from the end of the taxable period of which such exportation has taken place or supply of service is provided, as the case may be. Now, when we discuss zero rated supplies, I told you that you have to bring the foreign currencies through the banking system within 6 months to apply zero rate. Otherwise, it's not a zero rated supply. You have to apply the standard rate. Now, when we are going to claim our input taxes also, there is a restriction. If you don't bring the export proceeds, the foreign currencies through the banking system within 6 months, the input tax is also not deductible. What will happen if you don't bring the foreign currency within the given period? You have to basically apply the standard rate on the export proceed and pay it. You can't even deduct your input taxes. Right. That is to make sure that you bring the proceeds through the banking system to the country. Question number 9. Let's see how we can incorporate what we have learned so far into a sum. The following information is extracted from the books of accounts of PQR Limited, engaged in the business of manufacturing of goods for the taxable period ended 31st March 2026. All transactions given below are exclusive of VAT where applicable. So VAT is not included in these amounts. Under output, supplies to VAT registered person 3.5 million. That's the value of supply without VAT. Supplies to non-VAT registered person 2.5 million. Under input, they have import of raw materials 3 million. Local purchase of raw materials from VAT registered persons 1.5 million. Purchase of raw materials not supported with tax invoices 1 million. Salaries and wages 1.8 million. You are required to calculate VAT payable for the taxable period ended 31st March 2026. Well, first we have to calculate the output VAT. You calculate the value of supply first and apply the relevant rate on that, and then we can calculate the output VAT. So I have given here the answer. Supplies to VAT registered persons. Value of supply is 3.5 million. And on that you apply 18% VAT rate. The output VAT comes to 630,000. Supplies to non-VAT registered persons. The value of supply is 2.5 million. After you become a registered person, you don't have to worry whether your customer is a registered person. No. On the supplies you make, you have to charge VAT. So on 2.5 million, you apply the tax rate, standard tax rate 18%, and the output VAT is 450,000. The total value of supply is 6 million, total output VAT is 1,080,000. Then from this, we deduct input taxes. Import of raw materials, the value is 3 million, and we compute VAT at 18%, 540,000. Local purchase of raw materials from VAT registered persons, 1.5 million, and the rate is 18%, 270,000. Purchase of raw materials not supported with tax invoices, 1 million, and the applicable rate is 18%, 108,000. Salaries and wages. On salaries and wages, since employment has been excluded from the definition for taxable activity, that is not applicable on salaries and wages. So the total input comes to 990,000. But this includes 180,000, which can't be supported with tax invoices. So under input restrictions, we discussed that you have to have a document called tax invoice to support your local purchases. Otherwise, you are not allowed to deduct it. So from 990,000, we have to remove this 180,000 because that is not allowed to be deducted. So the allowable input VAT comes to 810,000. So that you can deduct from the output VAT. So the VAT payable comes to 270,000. So that's the amount that you need to pay to the government. Next question. In the above question 9, in addition to the output mentioned, if the company has exported goods amounting to 750,000 rupees and supplied exempt goods amounting to 1 million rupees, compute the VAT payable for the taxable period ended 31st March 2026. So what are the additional information details we have here? In addition to their general supplies, they have made a zero rated supply and also an exempt supply. So this is how you have to incorporate zero rated supplies and exempt supplies into the sum. First, we have to compute the value output VAT. Supplies liable at standard rate that we have already computed. 6 million is the value of supply, 18%, 1,080,000. Then we take the zero rated supplies. That's the exports they have made. The value of supply is 750,000. The applicable tax rate is 0%. The output VAT is 0. Taxable supplies. Then I have taken a total here. Taxable supply is the total of the standard rate supplies and zero rate supplies. That is 6,750 rupees. Output VAT is still 1,080,000. Then we have exempt supplies, 1 million. We know that there is no tax on exempt supplies. So there is no tax rate applicable and there is no output VAT as well. The total value of supply comes to 7,750,000 and the total output VAT is 1,080,000. So from this we deduct the allowable input VAT. Now, when we are going to deduct input taxes, there is a restriction. When your input tax relates to exempt supplies, you are not allowed to deduct it. It should be related to your taxable supplies. So I have given here a simple formula to compute the input tax attributable to your taxable supplies. So what is deductible here is the input tax that is attributable to your taxable supplies. So 810,000, that's the total input tax they have paid. And we divide it by the total value of supply, including exempt supplies, 7,750,000. And we multiply it by the value of taxable supplies, which is 6,750,000, to compute the input tax attributable to taxable supplies. So input tax that can be deducted is 705,484. So because input tax attributable to exempt supplies cannot be deducted. So the difference between these two is the VAT payable to the government. In this sum, it is 374,516. Right. So we have come to the last part of our discussion. Tax invoice. Here we are going to discuss about some basic requirements or compliance requirements that a registered person should comply with. So one of the important documents that we discussed is the tax invoice. I told you that without a tax invoice, you can't deduct your input taxes. So a registered person who makes a taxable supply shall issue a tax invoice within 28 days after the time of supply if he has made a written request within 14 days from the time of supply stating that he is a registered person or is deemed to be a registered person. Now, when you supply goods and services, when a customer comes, if he is a registered person, he has to inform you that he is a registered person and he needs a tax invoice to claim input taxes within 14 days from the time of supply. And you have another 14 days to issue the tax invoice to him. So after he makes the first request, or after he informs us that he is a registered person, then again he doesn't have to inform us because we know that he is a registered person, and we have to issue tax invoices to him to make sure that he is able to claim input taxes he pays on the purchases he made from us. However, where a request has been made by a person after the receipt of the first supply, such person is not required to make any further request in respect of any subsequent supply. Right. Now let's look at the composition of a tax invoice. What are the components that should be there in a tax invoice? If any of these items or requirements is not there, that's not treated as a valid tax invoice. The name, address, and the registration number of the supplier, name and address of the person to whom the supply was made, that's the customer's details should be there. The date on which the tax invoice was issued and its serial number, the date of the invoice, and it should be maintained. There should be a serial order. The date of supply and description of the goods or service. The supply date should be there, and description of the supply, what you supply. The quantity or volume of the supply. The value of the supply, the tax charge, and the consideration for the supply. Value of the supply, tax charge, and the consideration for the supply. In a tax invoice, the value of supply, VAT charge, and the total consideration should be there separately. And most importantly, it should say that it's a tax invoice. The word tax invoice should be there. So these components should be there in a tax invoice. Otherwise, it's not a tax invoice. So tax invoice on imports, as I told you, the customs goods declaration or any other document authenticated by the Director General can be treated as a tax invoice when it comes to importation. Where goods have been imported into Sri Lanka, the customs goods declaration or any other document authenticated by the Director General of Customs shall be treated as a tax invoice. Next one, retaining copies of tax invoices. When you make a supply, the original tax invoice should be given to the customer, but you have to maintain copies of the tax invoices for 5 years period with you. That's a requirement under the law. The original should be given to the customer and the copy should be retained for 5 years period. The original of the tax invoice should be issued to the person to whom the supply was made, and the duplicate of such invoice shall be retained by the person who makes such supply for a period of 5 years after the expiry of the taxable period in which such invoice was issued. Issue of copies of tax invoices. Now, you can't issue 2 invoices for the same supply. That is illegal. You can issue only 1 tax invoice. But if the customer claims that he has lost the original tax invoice, then you can issue a copy. You can issue a copy, but you have to mark that invoice or that copy clearly as a copy only. It is not lawful to issue more than 1 tax invoice for each supply. If a registered person claims to have lost the original invoice, the person who makes the supply may use to such registered person a copy, clearly marked copy only. You can't issue another tax invoice. What you can do is you can issue a copy, clearly marking it as a copy. Issue of non-tax invoices. Now, after you become a registered person, you are authorized to collect taxes. But when you charge taxes, if your customer is a registered person, you have to give a tax invoice. So in a tax invoice, you have to show the value of supply separately, tax charge separately, and the total consideration separately. Now, if your customer is not a registered person for VAT, you have to issue a normal commercial invoice giving the full consideration, including the VAT component. You don't have to show the value of supply, VAT separately. You can put the total consideration, including the VAT, when you are supplying to a person who is not a registered person. Where the recipient of a supply is not a registered person, such supplier shall issue an invoice giving the total consideration of such supply, including the tax charge. An invoice issued under this subsection shall not be considered as a tax invoice. It's not treated as a tax invoice. It's a commercial invoice. We have come to the final part of our discussion. Filing of VAT returns. Now, after you become a registered person, as I told you, what you do, the activities you do, the value of your supply, all that can be monitored. You should be able to be monitored by the Inland Revenue Department. So they can't see what you are doing when you are running your business. So there is a requirement to submit a document called the VAT return to the Inland Revenue Department, showing all the details, the total supply, taxable supply, zero rated supplies, exempt supplies, and the taxes that you have collected, and the taxes you pay on your local purchases, taxes you pay on your importation. So all that you have to declare with supporting schedules and submit to the Inland Revenue Department. There's a deadline for that. You have to submit this VAT return within 1 month after the expiry of the taxable period. So you have only 1 month period to submit your tax return to the Inland Revenue Department. Filing of VAT returns. Every registered person is required to furnish the VAT return not later than 1 month after the expiry of each taxable period. Then payment of taxes. When it comes to payment, we have a monthly taxable period and quarterly taxable period, 1 month and 3 months taxable period. But even if it is monthly taxable period, you have 20 days after the end of the particular month to make the VAT payment to the Inland Revenue Department. And if it is quarterly taxable period, again, you have to make monthly payments or no before the 20th of every month you have to make the payment by the 20th of each month. So the final payment can be made within 20 days after the end of the relevant quarter. Monthly taxable period on no before the 20th of the month following the end of the taxable period. Quarterly taxable periods on monthly basis on the 20th of the second month, that's the first month payment, and 20th of the third month, that's the second month payment of the quarter, and the balance by the 20th of the month immediately after the quarter. So that is how you have to pay back to the government, and after the end of the relevant taxable period, you have to submit your VAT return to the department with all the schedules and the details of that particular taxable period. Right, that's the end of the presentation. I had to run through the last few slides due to the limited time, but still you have the recordings of this, therefore you can watch these recordings later. Now, if you have any questions on the areas we discussed, please feel free to raise. Natasha Miss, do you have any questions? Sorry. If you have questions, please go ahead and put your questions in the chat box. Right. Then it seems that there are no questions.
Nadika sir, can you hear me?
Yes, yes, yes. I was
Right.
searching for you. Looks like
Yes.
the students don't have questions.
Okay. Right. So in that case, we can wind up the session, sir.
Right. Fine.
Right. So I have already shared the that slides with them. I have uploaded it to LMS. So students, you can download it if you haven't downloaded it yet. Right. So in that case, we can wind up the session, sir. Thank you very much. As I mentioned earlier, so you have continuously supported us. So we will hope that you will join next year as well, hopefully. So thank you very much and good night, sir.
Good night. And again, thank you very much for inviting me continuously. So
Yes.
I'm, of course, as you request, I will continue to support
Yes.
and share my experiences and knowledge. Thank you very much and have a very good night.
Okay, thank you, sir.